It's great to invest in a startup, and I invested at a $1 million valuation today. It's worth 10 or 20 or 50. But unless you're not able to liquidate that position, your paper returns really don't mean anything. In absence of a public market, the only way for VCs or for PEs to really make money is from secondary transactions and from M&A. And you naturally have a complete ceiling of what prices that can happen at, because the acquirers are only of a certain size. So you're limiting your own returns by not having a solid listing avenue. There's this false pressure that VCs are putting onto startups to sell or to do lots of secondary activity. So I think in order for us to make African VC successful, the next thing we have to focus on is building an exchange avenue where startups can list.
Hi, Kartik.
Awesome.
Nice to have you on the show. Very much appreciated that you take the time to be here.
Yeah, it's good to be here and good to chat Africa. Excited.
So you're currently based in Mauritius, right?
Yeah, I'm based in Mauritius, born and raised. I moved around a bit, but I moved back in 2020.
Currently, you're head of exits at Launch Africa, what's like one of the biggest pre-seed and seed funds in Africa. But maybe you could give us like a bit of the backstory. Like, I think you've been in the industry for 5 years now. Like, how did you get into African VC and being at such a great fund now?
Very interesting story. Frankly, I was not expecting to be in VC whatsoever. So just as kind of personal background, I did a lot of my early life in Mauritius. And then I moved to India to finish high school. After that, I went to France. So to kind of continue my education, went to ESSEC Business School. And then I had worked at a startup which was run by two students that were more senior to me, and then in my third year kind of took it over. We were in the crypto space in 2017, 2018, so it was super early days. But I got this very cool experience of trying to do something as college students and try to build something and not really succeeding, but at least really trying very hard, right? And so that was kind of the thing that got into me, and it stayed with me for a while. After that, my parents said, Kartik, you have to get a serious job and stop with all this crypto nonsense, because at the time, nobody really liked Bitcoin or Ethereum. So I went and I worked for Credit Agricole. I got an internship there. Super amazing experience. I was in the risk department at the global investment banking level. So I was looking at all kinds of transactions, RCFs, revolving facilities, leasing, some of the debt activities, some of the equity activities. And then I was in a kind of a position to negotiate for a full-time role. And I believe I was very good to get it. But then unfortunately, COVID hit and I was not able to continue those discussions whatsoever. So I found myself back in India because we were all graduating, and how sometimes Europe can be with African passports. So you kind of have to go back. And so I did. Ended up meeting Zach just through mutual connections. And at the time he was leaving Startup Bootcamp and starting Launch Africa. So it's very, very much early days, right? This kind of mid 2020. He had kind of this great thesis for a fund. I said, look, I'm very interested in Africa, having grown up in Mauritius. I was keen to contribute and really just put my skills to good use at the time. And so I joined him for some time looking for an internship. I kind of had seen it as a stepping stone to something else. But I think just the way that we worked together, I was hired kind of as an analyst role. I tried to do my best. And, over time, its internship kept extending itself and then finally turned into a full-time role. Then I found myself doing this full-time in like early or mid 2021. I've kind of been with them ever since, right? So it's been an insane journey, getting to see the start of a fund really from the get-go. First close, doing a bunch of the early investments, then moving on to more of an asset management role. As you know, our firm kind of grew really, really quickly, right? From 2020, 2021, 2022, we kind of really rode that growth wave that was going on at the time in VC in Africa.
Definitely. And I mean, one of the interesting things is also, I think, like the amount of portfolio companies that you have, right, per fund, right? I think it's 130 plus in just the first fund, with I think 30 million raised or something like that.
Exactly. Yeah, it was a $36 million vehicle, and then the first fund had 133 investments.
Okay. What was because I mean, like out of like a European or more US lens, you would say, okay, that's like pretty, like the check per company is pretty low, right? And you're pretty like spread out. What was the idea behind that? What was the thesis that you, I would say, have a pretty low capital concentration in the portfolio?
Yeah, so really interesting. Zach's thesis starting the fund was quite simple. Is he took a Pan-African view in the sense that there were regional VCs operating, right? So somebody who might say, oh, I'm interested in East Africa and I'll only invest in East Africa. Some people saying, oh, I'll invest in Nigeria and West Africa. Some people in Francophone West Africa. but there wasn't really a fund that was doing a Pan-African strategy. And we kind of wanted to look for the best deals in the best places and try and get into the best companies at that time. And we wanted to, with our first fund, at least prove out that a Pan-African strategy was possible, in the sense that, yes, you can manage a portfolio at scale across different geographies without really having staff in every single individual country. And I feel like that was a thesis that we wanted to prove to the market. And then once we did, a lot of other funds started also running a Pan-Africa strategy, right? So that was kind of the goal for us, to say, yes, you can actually do this on a Pan-Africa level. And then once you have a mandate that is Pan-Africa, you can actually search for deals in attractive places, whereas another fund might be restricted by mandate. So it gave us also incredible flexibility to work in places where maybe other VCs weren't really happy to go. So that was sort of, for us, the slight advantage in the market that we thought we had.
Okay. And I mean, today it's pretty common, right? Everybody's now pretty, on the one hand, sector agnostic, but also, runs Pan-African strategies, invests throughout the continent, and doesn't focus only on East or West. Yeah. Okay. And how was that like? How was that beginning time? Because I think it's rare that you have somebody who experiences the early days and the setup of the fund and then sees the evolution over time and coming a success.
Yeah. Look, the early days when we were kind of a 3-people crackpot team is something I kind of look back very fondly. It was a time where we ourselves as a fund were operating as a startup. And I feel like I do well in places where you have to take incredible ownership of the tasks that you have. And in the sense that there weren't really tasks, it was just, go out and find interesting companies for us to invest in. And so I would spend 10 hours on video calls with people throughout the day and then continue and actually start my day after that, right? And so that was an incredible period. I got to see not just the beginning, but kind of how a fund goes from what is just a 3-people team, like a startup fund, all the way to what we have become now, which is an institutional player, right? We have now 2 funds under management. We're also looking at individual region-specific vehicles, managed vehicles for specific capital allocators. And so seeing that journey for me has been the most interesting. So to see exactly how a fund itself goes from just being a few people and, selectively looking at a few investments to really putting in the governance, putting in, how do you manage a portfolio at scale? A lot of those questions we had to answer as we went along. And so for me, that was really the most rewarding journey finally, is we had to solve a lot of these challenges as we were growing. And I felt every single time we got past one challenge, you had another challenge of scale. It was like, okay, how do you do this now? So, for me, I just haven't had a boring day in the past 5 years because there's always something next to solve.
No, it's super interesting. It reminds me of one time that I joined a fintech company actually here in Germany, in Berlin. And I joined as the 30th employee. And then we in 2 years grew to 140 employees. And at the end also went public on the Frankfurt Stock Exchange. And it reminds me of that story that I experienced myself. It's always great to see stuff evolve from the beginning and then come to fruition. Yeah. That's amazing. And how did your role change? Because at the beginning you were intern, then analyst. I think at some point you were head of investment, and now you're more a head of exits. Could you explain that transition and that process?
Yeah, and I mean, typically, I think most people forget this when you work in VC is funds are very interesting companies in the sense that they deploy capital, and at the end of it, you have to liquidate the fund, right? So a lot of I think people come into venture capital and the first thing they see is investing, and mostly only investing. But really, your expertise of investment is truly tested at the time where you need to exit, because then you're really proving value along the line, right? And you have to show not just paper returns, but actually cash returns. And you have to be in the market yourself to evaluate those things. But maybe just to go back into kind of how my role has evolved, obviously I started primarily working on the investment side. When we finished our deployment cycle, at the time I was head of investments because the team grew. And so, we were managing about 4 people, 4 investment professionals that were themselves looking at deals in different places. And then when the first fund had been fully deployed, this was early 2023, where we had just made kind of the last investment, maybe in January or something. Obviously, me having done loads of investing, I kind of wanted to take a different role within the team. And I moved more into a portfolio management position. And essentially, the concept there was to, we have this entire portfolio at scale. I had made the investments, so I had a personal relationship with the founders. I felt that there was a better way in which I could contribute to the firm just by being closer to our founders. And so I did that. we, in comparison to other funds, are a shorter life cycle fund. So most funds in Africa are 10 to 12-year funds and plus 2 optional extension years. We are a 5-year fund plus 2 optional extension years. So we're quite a accelerated timeline fund. So
yeah, it's almost similar to private equity funds, right? That are typically have like 7 to 8 years cycle too.
Yeah, exactly. Very similar. And so in 2023, mid 2023, when the market was really, really terrible, what we were kind of doing was firefighting as portfolio managers, to firefight, make sure these companies survive. A lot of people at the time were, YC had put out this great piece on, become default alive. So a lot of focus was on becoming default alive at the time. And so we did that a lot of portfolio companies. And then now in 2024, we started to think about how do we start generating cash returns for our LPs. So, I mean, it's great to invest in a startup and you think, I invested at a $1 million valuation today, it's worth 10 or 20 or 50. But unless you're not able to liquidate that position, your paper returns really don't mean anything, right? It's kind of funny numbers. It's really at the time where you actually have to, it's not realized, right? So coming into this now head of exits role, my primary objective was to liquidate not the top performers, not the super top performers that we want to keep, obviously not look at any of the mid-market guys either because they're too difficult to sell, but kind of places where we felt that we had enough of an investment return and that these businesses have become mature enough to have maybe a strategic on board, maybe a different profile of investor on board, and try and just readjust a little bit the shareholder base. And so primarily what we've ended up doing in the past year is a lot of secondaries activity, so kind of internal to the team. Right?
Yep.
You may know that there are very, very few intermediaries in Africa, particularly in the secondaries market. If I'm not mistaken, there's not even one. So we kind of had to go out and build an internal investment banking team that was going out, which was primarily me going and hitting up people on LinkedIn and saying, hey, do you want to have a call with me? I have great companies and would love to show you some stuff. And
who did you, in that outreach, who did you target primarily? Later stage VC funds or strategic buyers or corporates even? Like who were the addressees of these outreaches?
Everybody. It was private equity funds. It started with private equity funds, then it went to late stage VCs, then corporates, then scale-ups, so larger startups on the continent. And the last thing that we are now starting to do is a bit more CVC. So that's primarily the outreach that we ended up doing at the time. And kind of the main feedback that I was getting from the market even around that time was, okay, this secondary business doesn't make any sense to me. Why would I give you money for shares, but I could just invest in the company? So a lot of the first year was, in my mind, knowledge building and knowledge sharing with the market. Right? That's literally all we ended up doing. So, talk to people, explain to them, look, this is how a secondaries process would run. And one of the interesting things that we were dealing with at the time was that a lot of your listeners might know of the YC Safe Note. That's a great way to invest in startups. It's a very, very easy instrument for you to, it's a simple agreement for future equity. It's a really easy transactionary document. All you have to do is sign and then wire the money. Now you're an investor. The challenge is we had deployed about 130 safes, of which only 5% had converted in actual equity. So how do you then we ran into this problem of, okay, how do you sell safes, right? Option on equity here. And now I have to find a way to sell this option on equity to somebody else. And so the first secondary deal that we did, we had to build out what we were gonna launch it sometime soon now. It's called the Launch Africa Safe Purchase Agreement, where essentially it is a empty backbone where you could fit in different safes for a transaction between, for example, you and I in a third business. The founders also party to that agreement, so they also sign it. And so we literally had to build a lot of these things from scratch. So we had to first kind of go out and do the knowledge building with people. And then secondly, build the transactionary stuff for them to feel comfortable enough. Then we had to go sell to the founders, say, look, this is not a very difficult thing. Just trust us on this. And then finally, after that, we were able to do the first deal, right? So the first deal took over 6 months from all of this process, but now we've we've brought it shorter and shorter and shorter. We've gotten better at it as a team, and now we can probably transact in a matter of weeks, right? I think the last SPA we call it is the last one we did probably was transacted in about 2 weeks time from start to end.
Okay, so you drastically shortened the cycle in that case.
Yeah.
Okay.
Very much so.
And in terms from a more macro perspective, if you think about exits within your portfolio and inside the VC context in Africa, I want to dive deeper into the secondary topic as well, but what other ways exist out of your perspective, like realistic ways to exit? Because we can get into that later. IPO is not really an option, right?
Yeah, so actually, I'm very passionate about that. So we will talk about that, but just let me give you first the kind of the main mechanisms. The first thing is
Yep.
obviously a pure secondary, right? It's a very simple secondary transaction. If you look at kind of historical exits and where historical exits have happened in Africa, it's primarily been M&A. So if you look at Stripe, Paystack, a lot of VCs made a lot of money from that. That was kind of one of the bigger deals. And then you had BioNTech buying that Tunisian InstaDeep startup, and so that was a great outcome for investors. And so we kind of see these very isolated moments in time in different geographies in which through M&As investors are making good returns, but the reality of it that they're very scarce. So you're not just going to run into so many of them all the time. The third one, which is at least to me in theory possible, and as much as I've tried to look for some of these transactions, is a sale from a VC to a private equity fund. If you look at America, for example, you have a lot of the Silicon Valley VCs investing into businesses, and then some of those businesses interestingly end up in the hands of people like Thoma Bravo, or I forget that other gentleman, Leon Black's fund. And I think that there are some companies that have done that transition in Africa and VCs have made return from it. It's just that the market is very, very very obscure, so we just don't get this information. And then the last one
So
is
like
just
typical,
listing.
so like typical late stage tech private equity players that would then raise funds to basically buy your early stage startups that become
Yes,
more mature
exactly.
now. Okay, yeah.
Exactly, yeah. Bought by a corporate, for example. And then just maybe to double click on M&A, you have really realistically it's kind of three different types. One is kind of a corporate player that's looking to buy a startup because they feel threatened by the concept of a startup coming in and eating their market, right? Then you have the scale up that's looking to acquire, to maybe expand geographies. I had kind of seen a lot of Nigerian fintech players when the Naira had devalued, interest in acquiring assets outside of Nigeria and the only purpose to do that was to diversify away from the Naira revenue base, right? So
Mm-hmm.
you see lots of different flavors of why people are. And then the last mechanism really to exit is listing and an IPO, which is something that I feel very strongly about. We can kind of get into that a little bit more, but those are broadly just the main exit mechanisms.
Yeah, no, it's a really great overview. I think also for founders, because especially first time founders, like they maybe are really good at building a product or they are like the business co-founder, but obviously at the end, especially if you raise VC, and most of them are even not that aware of it, you have to exit, right? They have a fund, they want to return money to LPs. So I think having that as an overview for founders as well is super, super cool. You mentioned that you're also really interested or passionate about the whole IPO, because what you hear most of the time is like, hey, IPOs in Africa don't work, there's no liquidity, you have to list at LSE or you have to list in the States, but then you saw what happened to Jumia or others. So yeah, let's dive into that.
So it's amazing that you bring up Jumia immediately, because if you look at Jumia stock in the past 6 months, it's up 230%, right?
Yeah.
And so in my mind, so maybe let me start with this. I think there is a general impression that listing in Africa does not make sense, nor is it. I understand the market liquidity is a challenge, but in my mind, what's happening in the markets is kind of a twofold, is a chicken and egg problem, where you have local equity funds that want to invest in the local exchange. They probably have a mandate to do so from the local pension funds or from wherever they raise money from. Unfortunately, they're not able to find the high growth companies to invest in. So all they end up doing is investing in the top 10 or top 20 of the listed companies on that particular exchange. And now who are those? They're your usual suspects. So they're the banks, your telcos, your insurance businesses, and maybe diversified groups.
Yep.
That might be in South Africa, you might have the mining guys. In Mauritius, you have a lot of diversified groups like CL, IPL, MCB being the biggest bank. And so in my mind, the chicken and egg problem is that not enough high growth startups are coming to the markets to list. And then the second thing is that the listed equity fund investors that are present, that I know in Mauritius, are simply not able to find them. And so it's kind of like your liquidity challenge rises from the fact that one guy is looking for supply of shares. The supply of shares is inexistent. The guy who's thinking about, is there demand for my shares in the market, is not seeing the demand because the demand's not on the exchange yet, because the supply is not there. So
Yep.
in my mind, I think we have to get out of this rhetoric, because here's the bigger picture. Think about this for a second. Let's imagine you are a VC business. How do you grow? How do you become a multi-billion-dollar unicorn that's then listed and then goes on? in absence of a public market, the only way for VCs or for PEs to really make money is from secondary transactions and from M&A. And you naturally have a complete ceiling of what prices that can happen at because the acquirers are only of a certain size. So you're limiting your own returns by not having a solid listing avenue. Now, let me take it further to say there are founders that actually don't want to sell their business at all. They raised money about 7 years ago, and now they're under this great pressure to go out and sell the business because they have to make VC returns. But the ideal avenue for them to do that is on an exchange, because then they keep control as much as they can of the business. They provide liquidity to the guys that are looking for liquidity, and then they can keep the business. Right now, because of the fact that we just don't have a credible avenue for high growth startups, let's say doing, $20 to $30 million in revenue, they just don't have a reasonable base to list themselves and raise money in the public markets and grow that business organically over time. And so there's this false pressure that VCs are putting onto startups to sell or to do lots of secondary activity, which is why we see so many deep liquidity discounts, right? Even some of the largest fintechs that you probably have heard of, the secondaries happening on those shares are happening at 40% discounts. And that's primarily because there is an actual liquidity problem, at least in the private markets, and the secondaries just operate that way. So I think in order for us to make African VC successful, the next thing we have to focus on is building an exchange avenue where startups can list, making sure we're bringing both at the same time. So we're bringing the startup side, but we're also bringing the listed equity investor side, and doing it in a way which is not, I'm not saying let's do cowboy capitalism and list bad companies. I'm saying let's go out there and list actual good companies because they're there, right? And so for me, one of my personal goals in 2026 is hopefully to try and work on one in Mauritius. I spend a lot of time with the folks at the stock exchange of Mauritius, primarily talking about this. And there are some interesting people locally that are doing something. The fifth most performing stock in the Mauritius Stock Exchange right now is this business called Africa Eats, which is an investment holding company of agri SME businesses in Africa, profitable, which are basically underlying startups, right? And now what the founder of Africa Eats is doing is listing them individually on the public markets in Mauritius. So I think we need to, as a collective, as a group that's interested in Africa, we have to really work together, collaborate to try and make that happen. Because I think without that, we're just not going to be as successful as the other emerging markets.
Yeah, totally. I mean, like, also from a VC perspective, I mean, that's also one question I had. Like, why does your fund size, why is it 7 years long? Why is it not 10 years long? Is it also due to the lack of liquidity in IPOs? Is that correlated?
Not directly. For us, the strategy was we would invest in pre-seed and seed and look for liquidity at Series A and B. So that was kind of our thesis, is startups in Africa had taken less and less time to get to Series A and B, at least at the time when we were drafting our thesis. And so we felt that this fund timeline was perfectly in line with our modus operandi of investing at pre-seed or seed and looking for exits at Series A and B. It wasn't really related to IPOs or listing or very long-dated exit outcomes.
I mean, it's super interesting what you just laid out, because it goes completely against what everybody else is saying in the industry. Like, everybody else just accepts this notion of, okay, there is no liquidity, we can't list growth companies. Out of a founder's perspective, let's say I actually build a successful business, right? Let's say I'm doing, 30, 40 million ARR and I'm growing 40% still a year. Is that already a stage and size within the African context where you think I could do a successful listing? Or where do I have to be as a founder to actually go through that process?
It's $1 million question because I can't answer and I don't know. But I think if you look at the growth of other businesses that are on the stock exchange here in Mauritius, the growth is just not there. So if you're saying that you're growing 40% year over year and you're adding net income every single year, that's a great stock for you to be invested in, really. And so I think there is potential in almost all of the exchanges. It's just that the exchanges have been dominated by legacy groups, legacy banks, insurance players that operate on much, much thinner multiples than high growth startups do, that just don't have as much of a cost base or an asset base. And so in my mind, I think it's too early to tell, but that is one of the things that I want to test out in 2026 is, can we take a business that is of that size, bring it to a local exchange, not the LSE or NASDAQ or any of the Asian exchanges, and see how that stock performs. So I think there's potential. It feels to me that there is potential, but It's something we'll have to figure out through trial and error.
Yeah. And the reason, just to highlight that, the reason you think that there is potential is because you see on the buy side that there, in theory, is that liquidity, just it gets allocated to more traditional stocks, right?
Exactly. Even if you look at kind of the secondaries market in Africa, I think people say, look, the secondaries market in Africa is just not deep enough. I absolutely disagree, because if you go out into the market and you're actually chasing liquidity rather than kind of sitting back and hoping that, liquidity will come my way, you can actually find it. You'd be surprised at how much liquidity there is in the market, how much people are looking for exposure to performing businesses. The challenge is that they just don't get to see them as much. I mean, imagine if, Louis, you were running a great startup, right? You would only, in a 5-year time frame, is maybe 3 times, which means you would only cross, out of all the 100 investors or 200, 300 investors that exist, you probably cross 20 or 30 of them at only 3 points in 5 years. Versus all of those people are looking to allocate to the most performing businesses possible. And so in my mind, at all times, there is liquidity that's available. It's just that you have to go out, be more proactive, talk to people. It's almost, for us, it's almost like an internal investment banking activity where we're going and we're talking to other investors about our performing businesses, explaining to them that we're looking for an exit, which very naturally leads to liquidity for us. So I think that there is a notion that liquidity is a challenge. I just think that most investors are unfortunately lazy.
Yeah. I mean, makes sense. So like, all you're saying is you have to be more proactive on the investor side, right? Like you have to actually be involved in talking to people. Okay. And maybe like go back to the founder's perspective, what do you think are mistakes that founders do at pre-seed, seed, that basically hinder them from actually being acquired or achieving that exit? Like, what are the common pitfalls that you see?
Yeah, the most common pitfall is benchmarking too high. So if already by your seed round you've benchmarked yourself at 10, 15, 20, 25 million dollars, you essentially have shareholders that are on board whose entry prices are too high. And when finally an M&A opportunity might come your way, it might not come at the prices that you're expecting. And as such, you're going to run into challenges within your shareholder base. So I think it's very important and prudent to worry about how much equity you're giving away and at what prices, because a lot of the primary valuations that I saw through 2020 to 2024 were a lot higher considering what we're seeing in the market today, including M&A transactions. And M&A transactions have always been slightly lower than primary financings anyway, right, in the first place. And so the most common mistake is to benchmark too high. The second mistake is to not be sure of your investors' timelines, because that can also complicate things, right? If I'm accepting an investor that's going to be with me on my journey for 5 years, and then I'm also accepting capital from somebody who wants to be in for 10 years, fundamentally there is a timeline mismatch, because the shareholder that's looking for an exit at 5 years will tell you, hey, look, it's kind of our time now. We have to liquidate and get out. And the guy who's got, still another 5 years in their fund absolutely does not want to do that. So worrying about and asking your investors what kind of exit they're looking for, in what timeline, and what their returns expectations are, I think is something that's very important. And all founders should ask that question back to their investors to say, are you going to help me in my pursuit for liquidity when you ask it, or will you be an investor that just tells me go find liquidity for me and I have to go and worry about that? I think as an acid test for founders, that they must apply on the investors that they accept.
So just basically also aligned incentives, right? And aligned timelines. I think even like if you're looking for a co-founder or something, you also should do that, right? Like, what are your incentives? What are your goals? What are your timelines? And if they're misaligned, then it probably won't work out.
Exactly. And everybody thinks about the start, but not really about the end. And I think we do have to kind of think about that, right? And make sure that from the get-go. And you will also hear about many things. I think if an investor sits across from you today and you as a founder are raising money and they say, look, I'm looking for a 100x outcome, but they're investing at a $10 million valuation, well, you really have to ask them the question is, what really is your goal here? Because that's not going to happen in 5 years. It's going to take longer than that, unless you're a super, high-performing business. So investor expectations are also something to test, and it's something that I think must be discussed at the time of investment, almost like as an open discussion to say, what are your expectations out of this investment, and how can we make that better together, right? At the end of the day, it's a collaboration. It's not really It's not really a fight, right? We're not sitting on different sides of the fence. We're on the same side of the fence, and we have to make it work together. So I think these are things that I would encourage founders to think about before they accept money.
No, it's very insightful. And what I also wanted to touch on is the LP perspective, especially people maybe that are in Europe right now or in the US that with the local developments want to maybe allocate to Africa. How would you, out of their perspective, vet funds, especially like early stage VC funds, if they were to want to allocate to that asset class in Africa?
The LP perspective on how to select fund managers is something interesting because I think every single LP arrives with a different set of incentives. There are people who see VC as an asset class as almost, it's 5% of their family office. They see it as philanthropy. Some people see it as an actual commercial way, and they think of, if I invest $100,000, hopefully in 5 years I'll make 500,000. And then Africa is very much still dependent on DFI capital. And a lot of that DFI capital comes with strings, but it doesn't come with the same kind of accountability that maybe funds in Europe and America have to deal with. In the sense that if, for example, you have a 12-year-old vehicle that was supposed to be an 8-year fund, has not returned, has not done any distribution, has not done any exit, chances are that fund manager will raise another fund, but that just simply would not happen in America or in Europe, right? Or even in India for that matter, right? You continuously have to deliver on exits and DPI in order to raise your next fund. And so in my mind, I think what LPs must look for when looking at an African fund is how diligent is the investor in terms of their entry and their exit? And are they able to, on every single exit, deliver a profitable exit from an IRR perspective? From a time-weighted perspective, not just on a multiples basis. And do they have good startup selection processes? Are they able to find the best pipeline that's available? Do they have a good reputation in the market? And that's where kind of the founder perspective comes in. I think we as Launch Africa have been one of the most founder-friendly and the best people to kind of work with. A lot of founders will tell you. And there are definitely others that are absolutely not good to work with. Right? It's not surprising. The founders tell me. And so I think those are the things that LPs not look at is, is the fund manager delivering exits? Are they able to liquidate their positions? Are they actually making an effort to actively manage their portfolio? And after that, I would say almost in a secondary way, what is their startup selection kind of hit rate?
Okay. You mentioned like one criteria is building pipeline and obviously like being able to be in the best businesses. Because you obviously also had the head of investment role, what was the process like of building that pipeline?
Building pipeline for us at the time was, the way that we thought about, okay, how do we find the best startups to invest in? Zach, our GP, who is also the founder of Launch Africa, had previously run Startup Bootcamp, which was an accelerator fund. And so they had invested so Kuda Bank came out of that accelerator, for example, right? One of the largest digital banks in Nigeria. So one of the things that we took from that lesson from that experience, one of the lessons we took from that experience was, if you look at a lot of the local accelerators, because there were many of them at the time that were operating, kind of at their first cohort, their second cohort, or their third cohort, our concept was to work with them to evaluate who the best performing startups are from their cohorts and to just invest in them. Because if, for example, a startup is able to go in the span of a year and a half from just, 2 people in a room with nothing, but then come to the end of that year and a half, and now suddenly there's a business, there's a product in the market that's generating revenue, where your customers actually like you, that's, in my view, for an early stage investor, an investable proposition. Because it took you a year and a half to go from nothing to a product in the market, your customers like you, and they like to pay you. So the way we built our pipeline was we already had relationships with most of the accelerators, a lot of the pre-seed funds from all over Africa. So North Africa, East Africa, West Africa, Francophone West Africa, Central Africa investors, and obviously Southern Africa. And we spent time with them evaluating who their best performing startups are. And that's really how we build pipeline. After a while, people started coming to us. But in the early days, that's sort of how we had to do it, is we had to go out and chase the startup as opposed to the startup coming to us. After a while, it kind of flipped where we started to get a lot more pipeline than we were going out and looking for it.
I have a bunch of like quick fires for you, like just like a couple of questions that I wanted to ask. If you had to like rank product, founder, and market, what would you deem as the most important, especially in the African context?
Product, founder, market. So which is the most important?
Yeah, like just you can rank them 1 to 3. Like most important, in the middle, least important?
So I think if you have a great product, you can have a terrible management team and you will still have a good business.
Mm-hmm.
You can have a great management team, have a terrible product, and have no business ever, right? So for me, and just having seen a lot of startups, I would put product and market first, not to underplay the role that founders play in those successful products either, right? But
Mm-hmm.
it's just that I have seen so many times a lot of people come from great Ivy League backgrounds with great experience, but unfortunately are just unable to build a product. It's because they haven't seen the problem firsthand, right? Is they kind of come from a more consulting lens rather than having dealt with the problem themselves or having built a product themselves before. And so what I see a lot of people that just built great products at the end of the day are not really the most flashy founders, right? They're not on your large conference panels or stages. They're actually just quietly building and chipping away at very, very large markets. So
Yep.
in my mind, it would be product, maybe then founders, and then lastly market, because you can find the market, right? We have a startup that's now their clients are spread across the world already, right? And it's primarily
Mm-hmm.
because they have a really, really interesting niche product, but they just found their customers elsewhere. They're operating out of South Africa, but their customers are elsewhere. And
Mm-hmm.
so in my mind, what that speaks to is great product, great founders, but the market will find you if you have a great product anyway.
Yep.
So that's
No,
kind of how I
totally.
would think about it.
Okay. Another one, if you had to invest in another pre-seed or seed fund in Africa with your own money, but you're like the LP, which one would it be and why?
I would give money to a seed or pre-seed fund. I would give money to We Capital because they made a
Mm-hmm.
lot on Money Point, and I'm hoping they find the next one.
Okay, sounds good. And lastly, what is one sector or market that you find really interesting right now, but you think nobody's talking about or people are overlooking?
Yeah, there's not going to be a quick fire answer, unfortunately. I think there are outside of the big four, the most interesting markets are outside the big four because here you have markets where you just probably don't have as much funding or as many startups. And
Mm-hmm.
so you're operating in a way that's kind of almost completely blue ocean, right? From a startup perspective, because nobody's really doing
Yep.
that there. And so I think the opportunity actually lies in markets that are adjacent to the big four markets. And so if you think about, for example, Botswana, right? We were invested in this insurance, out of the box insurance business in Botswana. Incredible business, no competition whatsoever. Right? They've been growing organically, profitably for the past 5 years. It's an incredible business.
Mm-hmm.
They just don't need the kind of funding because they don't have competitors. We were super early in this business called Mad in Senegal when they were running it out of a garage. At the time,
Yep.
nobody was really looking at investing in Senegal, but we did like kind of our first seed check alongside another fund that was a local fund. They had done a very smaller, comparatively smaller check. But then that business is probably now 500 times that size. So
Wow.
I think that there's opportunity. It's just you have to go to the right markets to find it, right? Kind of more underserved markets is where you
Yep.
will find lots of opportunity. So, and then as an example, I know you said before we were talking earlier that you're of Cameroonian descent. In 2020, 2021 or 2022, one of the first deals that I ended up working on as part of Launch Africa was in a health tech business in Cameroon. And the product was so amazing that they hit virality as soon as they launched their app, right? So people were downloading their app left, right, and center. And then they learned how to monetize that going forward. I would say, look where nobody else is looking because that's where you'll find great opportunities.
Yeah. Sort of like go against the mainstream, then you find great opportunities. Yeah, makes total sense. Yeah, I mean from my point, that's it. I think really, really interesting insights and perspectives that also few other people hold, especially I think about IPOs and how you engineer secondaries. Yeah, where can people find you if they want to reach out or talk about potential secondaries?
Yeah, LinkedIn is the best. And I have no problem putting my email out either.